Hello, my name is John Burke, and I want to welcome you to the most important presentation you will see all year. And I don't say that lightly. The National Retirement Risk Index, published by the Center for Retirement Research, shows that the share of working households who will not have enough money to maintain their pre-retirement standard of living has jumped to 53%. When retirement health care expenditures are included, their research shows that percentage can increase another 15%. That means the typical worker has about a 70% chance of outliving his or her money in retirement. What you're about to see will make sure you're not one of them. So, if you're in retirement, planning for retirement, or just hoping to retire one day in the future, this message couldn't come at a better time. In just a moment, you're going to learn how one simple contract can guarantee you'll never run out of money in retirement. In fact, once you see how simple it is, you'll wonder why you hadn't seen the power of this overlooked annuity before now. And that's precisely why I've asked Joe Stark, CEO of Florida-based insurance agency Crown Atlantic Insurance, to join us today. Joe has spent most of his 28-year career helping everyday people just like you use this annuity contract for a lifetime income. He is one of the nation's leading experts on these often forgotten money-for-life annuity contracts. And Joe is here to lay them out for you plain and simple. Welcome, Joe. Thank you for joining us today.
It's a pleasure to be here. Thanks for having me.
You're welcome. Now, Joe, before we get into the details of this money-for-life annuity contracts, many of our viewers heard the shocking statistic for the first time that 70% of today's workers may outlive their money in retirement. Well, that's nearly 3 out of every 4 retirees. Are things really that bad?
Unfortunately, John, they are. I've spent the better part of 3 decades helping individuals live worry-free retirements. And right now, the situation is worse than I've ever seen it.
What are the factors driving these startling statistics?
Well, the first thing is that people are living longer, but most people aren't prepared for it. Today, people are actually living much longer than the quoted average life expectancies. And a study by the Social Security Administration shows that Americans making $50,000 a year or more can add at least 6 years to their average life expectancy. The point is, there's a very good chance that your viewers today, on average, will live to at least age 85. If you stop and think about it, you probably know someone who's well into their 90s or maybe even 100 years old. If you retire at age 65, you could be looking at 25, 30, or even 35 years of retirement.
That's a long time to cover financially.
Exactly. But this is only one of the reasons most people are outliving their money in retirement. The other one is massive losses of wealth from multiple market downturns, with the possibility of more in the future. The dot-com collapse wiped out about $9.5 trillion in American wealth. And devastating as it was, many investors were still in their prime earning years and were able to make a comeback. But then we had the run-up in housing, which led to the mortgage meltdown, a collapse of global credit markets, and the worst financial crisis since the Great Depression. This time, the losses were around $14.8 trillion.
And it wasn't just individual investors who suffered this time. It was homeowners, too. People who may not even consider themselves as investors.
Exactly. For many people, their home is their largest asset. So when the real estate market crashed, it took a huge chunk of their wealth with it.
So where does this leave our viewers right now?
Well, many feel they're stuck with 2 choices. They either put their money at risk in the markets and hope the timing works out, or they can sit on the sidelines, play it safe, and possibly outlive their money.
Yeah, see, that doesn't sound like much of a choice, because either way, there's a chance you'll run out of money.
Pretty much. But what if I told you you didn't have to make that choice? What if you could participate in growth linked to a market index, like the S&P 500, but maintain protection of your principal? In other words, grow your wealth using this index-linked method for higher excess interest rates over the long term without exposing your money to market risks. And more importantly, without the risk of outliving your money when you retire. And you can do it by what I call the money-for-life annuity contract.
Can you explain what you mean by a money-for-life annuity contract?
It's an alternative for a portion of your money earmarked for retirement. Even our founding father, Ben Franklin, prior to his death in 1790, used one of these contracts to pay his beneficiaries. In fact, the last payment from his money-for-life contract was made in the 1990s after more than 200 years of income payments.
That's like 2.5 lifetimes of income.
It sure is, John.
Yeah, this is amazing. So what you're saying is that there's a concept or contract passed down through the ages that protects my principal and the interest credited in previous years and can guarantee an income for life, even if I live to, say, 110 years old.
Money for life contracts are financial contracts that are annuitized. And this just means that one contracted party agrees to provide the other party with a series of payments for a specified period of time.
So this money for life contract is an annuity.
Exactly. And here's the really great news about how annuities are brought into the market. You see, annuity contracts are offered by most of the major insurance carriers.
Okay, so the insurance companies back the guarantees provided by the money for life annuity contracts?
Yes, insurance contracts are backed by the financial strength of your insurance company. They're not bank deposits, and so they're not insured by the FDIC.
You're watching a Newsmax TV special presentation. Discover the Money for Life contract. Find out how an annuity can improve your retirement income by up to 30%. You've been watching John Burke on Newsmax TV's Discover the Money for Life contract. Find out how you can increase your retirement income up to 30% using a trusted annuity. Get our free annuity primer report. Simply go online or call Crown Atlantic today.
So there are a lot of misconceptions out there about annuity contracts. Can you tell us a little bit more about how these contracts work in plain English?
There are four main types of annuity contracts. Now, the first is the traditional fixed annuity contract. In this type of contract, the insurance company assumes all the risk. It gives you a fixed interest rate on the premium you've paid into the contract. Here, the interest rates are fairly conservative, but you do have the benefit that your money grows tax deferred. And this means that you don't pay any taxes on the money until you start receiving an income from it. Plus, you have the benefit that this income can be guaranteed for the life of the contract. You should, of course, consult with your own tax professional to confirm how the tax treatment would apply to you specifically.
So while this contract may not give me some high-flying dot-com gains initially, I can rest assured that I'm going to get a guaranteed income.
Exactly. And the same holds true for the next type of annuity called a single premium immediate annuity. Now, this contract takes a single payment up front, and then it guarantees a steady stream of income for a set period of time. Now, that could be 5, 10, 15, 20, 25 years, or even a lifetime of income. You get to decide what works for you.
Now, this type would also give you payments for life, helping you avoid becoming one of the 70% of today's workers who are likely to outlive their money in retirement.
That's right, John. These two contracts have the insurance company assuming all the risks for making sure you have a lifetime of income payments. And that brings us to the third type of contract called a variable annuity contract. Now, this contract allows you to put your money into different investment strategies. And while these varying strategies can help your money grow faster, you assume the risk of the underlying investments, not the insurance company.
Okay, so let me see if I understand this correctly. The first two contracts will give me a guaranteed income, but the returns may be a little bit lower.
That's right.
All right, and then this third contract may give me a greater return on my money, but the potential for greater gains could also have the potential for losses since my money is at risk.
You've got it. This variable contract is also a type of securities contract. It offers you an array of buckets you can put your money into called sub-accounts. Now, these are similar to the choices you might have when picking a group of mutual funds. You get more potential upside, but you take on the risk if the investments don't perform, so you can lose your principal. Plus, there can be some pretty significant management fees and expenses in the investment sub-accounts, so it's important to understand your total cost on these variable contracts.
That sounds like something that could cause you to suffer some setbacks if the markets crash like they did not so long ago.
Well, that's true, and it's very important to think through what your personal tolerance for risk is. Just how much of the money you've earmarked for retirement are you comfortable exposing to those market risks?
All right, well, not much for me personally. I mean, I've grown to appreciate Will Rogers' famous quote, "I'm more concerned with the return of my money than the return on my money."
I'm sure many of the viewers have the same attitude for a percentage of their retirement money as well. That's why the fourth type of annuity is hands down one of the best money for life contracts that I've ever seen. The last contract type is called an index annuity contract, and its features have fueled a rapid rise in the issuance of new money-for-life contracts, especially as people understand the insurance companies survived the financial crisis better than many institutions.
Okay, so can you explain these features just a bit, and also how an indexed annuity could work for everyday folks like me, as well as for our viewers today?
Sure, John. Fixed index annuities are the evolution of a traditional fixed annuity in that they both have guaranteed minimum interest rates and tax-deferred accumulation. But in addition to those, the indexed annuity adds an interest crediting method, and it's based on index-linked growth, all while safeguarding your principal by protecting against index declines. But here's the best part. While you still have the benefit of participating in the upside of the market, when the market turns down, as it typically does, your premium and interest credited in previous years can't suffer because of the index having a bad year.
What would this look like in practice with the ups and downs of the market? See, I'm wondering how much income could come from one of these annuities, and I imagine many of our viewers are probably thinking the same thing.
Certainly, and I think the best way to illustrate it is to look at a hypothetical situation of how an indexed annuity contract would have performed against some representative market index ups and downs. Since we're a tightly regulated industry, it's important for me to point out that past performance is not necessarily indicative of future results, and that the crediting rates and methods used in this demonstration may vary from those currently available.
Regulation can be good.
So let's take a look at a hypothetical indexed annuity's performance against a market index during the same period of time. Now, for the purpose of this example, the fixed index annuity has a 5% cap rate, and interest is calculated annually. We're using a point-to-point method. As you can see, for the first 2 years, while both did great, the market index would have outperformed our annuity. And while you can't invest directly into a market index, if you had investments that mirrored the index, our example shows the investments outpacing the annuity.
Well, that would be great if that trend continued.
It sure would. But the next year is somewhat shocking and really illustrates the difference with an index annuity where you have principal protection and controlled interest crediting versus an investment with principal at risk. As you can see, the index annuity is flat with no improvement, but interest credited in previous years as well as your initial premium is protected. While over here, the market index has fallen dramatically to an amount well below the initial investment. It's important to note that the investments don't have principal protection. Over the next 4 years, the market index gets back to where it was, then shoots up during a couple of good years back to back, while the index annuity at the same time continues its steady climb. Now keep in mind, the owner of the annuity contract has had no exposure to market risk all this time.
Now that is incredible.
Now again, after 4 positive years, our market index heads south. Similar to 2008 when we saw dramatic losses. In this example, we see a significant drop in the index. But notice what happens with the index annuity. The protection of principal and interest previously credited kicks in.
Okay, well hopefully the market investor wasn't planning to retire that year.
Great point, John. An index annuity can help protect your retirement nest egg in those critical years just before and after retirement, when you may not have the number of years necessary to recover from one bad year in the markets. Now, most recently, we've seen a few years of growth in the markets. What's it going to do next, John?
Well, I don't know, but I'm guessing that's the point.
Exactly.
All right, I see that in the up years, the indexed annuity does not jump up as quickly. It makes sense that the insurance company obviously can't credit you with all the upside in the good years and protect your principal and past interest in down years. And you mentioned a cap. Now, how does all that work?
Well, great question, John. The easiest way I find to look at it is there's a floor, or principal protection and interest previously credited. Then there's a ceiling, and your credited rate will be somewhere between the floor and the ceiling.
All right, so the floor is protection of premium and past interest?
Yes. Notice as the market index falls in these 2 years, the principal and past interest on the annuity remain intact. Also note that the index annuity has a minimum guaranteed contract value. Now this is a secondary guaranteed value that your contract will never go below, even in the unlikely event that the index stays flat for an extended period of time. You'll be guaranteed this minimum value. And that value is spelled out in your contract so you get it in writing.
Okay. I see how the floor works. Now, how do they determine the ceiling?
The insurance companies typically will use one of three methods or a combination of any of these three: a cap, a participation rate, or a margin. Now, a cap is basically what it sounds like. For example, if you have a 6% cap and the index rises 8%, you get 6%. But if you have a 6% cap and the index rises 5%, you get the full 5%. But, and here's the important part to understand, if the index falls 8%, you get 0% and no loss of principal.
That's the principal protection feature.
Correct. A participation rate credits you with a percentage of the index increase. So let's say you have an 80% participation rate and the index goes up 10%. You get 8%. If it goes up 5%, you get 4%. But again, if it goes down 10%,
you would get 0% and no loss of principal?
That's right. Now, the third method we see used is called a margin or a spread or sometimes an administration fee. This method takes a percentage off the top before any interest is credited. So if you have a margin of 2% and the index went up, say, 9%, you would get 7%. If the index goes up 3%, you would get 1%. And if the index went down, the insurance company would not subtract a margin in those years. You simply get 0% credited and...
protection of principal and interest credited in previous years.
You've got it, John. Now keep in mind that the insurance company is taking all the investment risk. You're not invested in the market. You simply are credited interest when the index your annuity is linked to does well. The insurance company is guaranteeing that your principal and interest credited in previous years is protected. The important concept to take away is that you're credited with interest, which is partially determined by how well the index does that your annuity is linked to. But you're protected from market risk in years that the index goes down. And depending on your spending goals in retirement, the timing of these losses could send you back to work or even delay your retirement indefinitely.
Yes, and those downtimes can create a lot more sleepless nights.
Well, yeah, there's a lot to be said for having confidence in your retirement strategy.
You're watching a Newsmax TV special presentation. Discover the Money for Life contract. Find out how an annuity can improve your retirement income by up to 30%. You've been watching John Burke on Newsmax TV's Discover the Money for Life contract. Find out how you can increase your retirement income up to 30% using a trusted annuity. Get our free annuity primer report. Simply go online or call Crown Atlantic today.
So with the indexed annuity contract, you get additional interest credited when the index does well, but in the down years, the principal and interest are guaranteed. All this while having the option to turn on an income stream for life no matter how long you live. This way you can grow and protect your money at the same time.
Exactly, and that's what makes this presentation more important than ever. The volatile times that we've seen, not likely to end anytime soon.
How can we connect our viewers to you and your team so that they can get the information they need to determine which of these contracts would work best in their specific circumstances?
Well, as you've seen, there are multiple annuity contracts, so to make sure we can get the right information out to your viewers, we have a national network of representatives who have the ability to custom tailor these annuity contracts to not only meet each person's unique retirement planning goals, but who will be familiar with the insurance regulations that affect the availability of certain annuity contracts in each state. To get started, all someone needs to do is call us at the number below, or they can complete a short form on our website to get our annuity primer report. And one of our representatives from Crown Atlantic Insurance will contact them in the next 24 to 48 hours.
All right, well that's easy enough. Thanks again, Joe, for being with us today. Appreciate it.
It's been my pleasure, John.
Now, for those of you watching, you've just seen how a powerful and widely overlooked concept can grow and protect your wealth in any market. And by taking one small step right now by either calling or completing a short form online, you'll be on your way to making sure that you're not part of the 70% of today's workers who are likely going to outlive their money in retirement. I'm John Burke. Thank you for joining us for this special presentation of the Money for Life contract.